Bob Murphy Show, episode 417.
There's a tidal wave coming. What you gonna do?
Get ready for another episode of The Bob Murphy Show, the podcast promoting free markets, free minds, and grateful souls. It's your source for commentary and interviews conducted by a Kristian and economist. Now here's your host, Bob Murphy.
Hey everybody, welcome back to the Bob Murphy Show. Today I'm speaking with Kristian Fors, who's a research fellow at the Independent Institute and director of their California Golden Fleece Awards. So his research with Independent focuses on public policy and economics with an emphasis on government waste and inefficiencies in California. So today we're focusing on a new policy report that he has out with Independent, focusing on the problem with homeowners insurance in California. And so the report explains what the issue is and then diagnoses why it's occurring and then gives some policy recommendations. So I have Kristian on to walk us through some of his main points. Let me say, for those of you, probably the vast majority of you, who are already staunch free market policy endorsers, there were some subtleties in this discussion that came up later on, like interactions with various types of government regulations that I opposed for different reasons, but then saw, oh yes, I can see why that would feed back into this particular issue as well. So I encourage you to go ahead and listen to it, even if you think, oh yeah, I already agree with this guy after 2 minutes of listening. Without further ado, here is my discussion with Kristian Fors. Kristian, welcome to the Bob Murphy Show.
Thank you. Thank you for having me.
Sure thing. So you have a new policy report out from the Independent Institute about the California housing market. So why don't you maybe just explain, what is the situation? What's the issue here that we're addressing?
So I don't know how much people know about this issue across the nation, but California is facing a homeowners crisis, a homeowners insurance crisis, where majority of the top major insurers have actually stopped doing new business in the state. And many of the biggest companies, such as State Farm General, have actually failed to renew thousands of their old policies. And part of the issue is, California's recently been in the news for the wildfire issue. So an insurance market is a function of two things. It's a function of written premiums, right? And then risk. And the issue in California is that we have a regulatory situation in which insurance companies are prohibited from charging premiums that actually reflect the risk that they're entailing with a lot of these home insurance policies. So because of government intervention, it's become completely unsustainable for insurance companies to remain in the state.
Okay, so as far as the non-ideological average person, the issue is what the heck all these major insurers are pulling out of the state of California in terms of getting homeowners insurance. That's the problem.
Yes. Okay.
And all right, and so you're alluding to what you think is going on that of course resonates with me as well. That there's regulation involved. So is it at this point where we should get into what Prop 103 is? I know that's a big part of your narrative.
Yeah, so the first thing I'll talk about is, so as I mentioned, 7 of the top 12 insurance companies have stopped doing new business in the state. Something else that's also very noteworthy is, so in California, we have something called the FAIR Plan, which is almost like, it's not a surplus insurance broker. It's more like a state-funded government. It's a legally mandated syndicate of insurance companies that come together to create a insurer of last resort. So because of the insurance crisis, the FAIR Plan is actually like it's on the brink of financial insolvency. So despite this syndicate's grown year after year, and more people are being forced onto this policy. And despite the fact that they have about, I believe it's $500 billion in total exposure, their written premium is only about $2 billion per year. So the fact is, insurance companies are leaving the state, and the alternative that the government has provided is not as a financially sustainable option.
Okay. And so then how does Prop 103 interact with all this?
So Prop 103 is the main insurance regulation in California. Prior to Prop 103, so Prop 103 was passed in 1988. Prior to this proposition, California was an open market insurance state in which open competition primarily regulated the insurance marketplace. But Prop 103 created something called the prior approval system, in which property and casualty lines of insurance, those rates must be approved by an elected insurance commissioner prior to their use. So if I wanted to raise my rates by, let's just say 5%, I wouldn't be able to do so. So let's just say you're in an inflationary situation, inflation is raging, and your building materials have gone up 20%. Instead of being able to raise by 5%, 7%, or 20% in the instance of inflation, I have to go submit a long, extensive application to the California Department of Insurance and wait for approval. So Prop 103 has other restrictions, like, for example, you can't raise your rates more than 7% without a hearing. But just in spite of that, the wait time and the regulatory lag of the system is incredibly burdensome. So it can take months for rates to be approved. And there's also something called the consumer intervenor process, by which consumers and their representatives can challenge rates. And that's a whole nother can of worms. But for non-intervened rate filings, the regulatory lag is still months. So when you are forced to wait months just to raise your insurance rates by 6.9% in an inflationary environment, when building materials are the price of building materials are increasing, and you have increasing wildfire risk year after year, you can imagine that over time, the discrepancy between actuarially sound rates and the rates that are permitted by regulators is going to get wider and wider.
Okay. So, I mean, it's effectively a price control.
Mm-hmm.
And so as any normal person who's taken econ, even probably 101, can say that, yeah, if there's price controls and all of a sudden you're wondering why are these insurers pulling out of the state, that's a pretty obvious explanation that these various regulations are interacting. And then with the scenario of, like you say, the wildfires and rising cost of replacement materials, that it's no longer, they're not allowed to charge what they would need to break even. So why would they continue to do business there?
Yeah, so one good example of this is, so as I mentioned earlier, the biggest insurer of the state is State Farm General. It's about 20% of the state market share. Policyholder surplus is a reserve of money that insurance companies have to pay out claims in addition to their normal financial reserves. So the policyholder surplus of State Farm General went from about $4 billion in 2016, I believe, and over the last decade, it's declined to, I think, just over $1 billion in December 2024. So the financial ramifications of these policies and these price controls have become evident when you look at the numbers.
Yep. Okay. All right. So that's you've talked about what the situation is. You've given your diagnosis. And so now what's the prescription? Like what do you recommend in the policy report that people do?
So Prop 103, there's the complicated thing about insurance is there's so many little facets of this issue. It's sort of hard to know where to begin. So to talk about one of the issues, so Prop 103, it subjects rates to prior approval, but it also, one of the prescriptions of Prop 103 is that rates are not excessive, unfair, or discriminatory. So by saying that, it also subjects the rates to a litany of other regulations. So one of the restrictions in California was that we weren't allowed to use something called forward-looking catastrophe rates. So for something like pricing wildfire risk, the previous regulations were that wildfire risk had to be priced based on the past 20 years of historic loss data, which is ridiculous, especially in a state like California, which claims that climate change is one of their major initiatives. So the climate change ideology is going to assume that wildfire risk is going to increase. So the fact that California was quite regressive on this issue was a big deal. So the best way forward is not only so you need to allow the inclusion of all relevant risk variables, including catastrophe risk, including the price of reinsurance costs. But most importantly, you need to completely allow free market rate setting. If there's a certain risk threshold and an insurance company exceeds that in their premiums, their competitors will view that as an opportunity to undercut the competition and to increase their market share. I think that the insurance market, it's the perfect example of what happens when a homogenous good is allowed to compete in a free market. And the California Insurance Commissioner and these regulations are a solution to a problem that never needed to be solved.
Right. Okay. So if I'm understanding you, you're saying, why don't we just unpack the thing about the wildfires? Because I want to make sure the listeners are catching that. And I had Lawrence McQuillan on, a while ago, like talking about the wildfire issue and some of this stuff. So my listeners will know some of these things already, but just to hammer that point. So you're an insurance company operating in California. You're granting homeowners policies to people. Somebody's house gets taken down in a fire, you're going to compensate them and so forth. So clearly the risk of homes burning down is, a major thing you're going to want to put into your calculations when you're determining, what should we charge for premiums on newly issued policies. And so if I understand what you're saying, that Prop 103 what is that? Is the stuff, the backward looking stuff, is that in Prop 103 or is that somewhere else?
So Prop 103 subjects California to those restrictions because there's this whole other set of regulations. I think it's Title 10, Chapter 5 of the California regulations. And that is part of Prop 103, that when the insurance commissioner is looking for the adequacy of rates, these rates are also subject to all these other regulations.
Okay. All right. So so it exists perhaps elsewhere, but Prop 103 sort of codifies it or endorses it. But so the point being, like you're saying, in a total free market, they could set whatever price they wanted. And if some person, some group was baking in assumptions about the risks that were implausible, then some competitor would just come in and, offer lower premiums. And that's how you deal with it. But here, because the rates are subject to regulatory approval, that to justify a rate increase and saying, oh yeah, because we're worried that, wildfire risk is higher, they're not just going to allow you to say, hey, based on the last 2 years, this is what happened, and we think this is the new normal, and so we're going to price accordingly. They're going to say, no. If you look over the last 20 years, really, 18 out of the 20, there wasn't a big fire deal, and so therefore, blah, blah, like, I'm making up numbers, but you're saying that's kind of how their hands are tied. And then the extra irony that California ostensibly is very forward-looking when it comes to climate change, and this is what's going to happen, and we got to have a carbon tax and do all this other stuff and, go net zero because of all the stuff that we're doing, looking at the year 2050. And yet here they're kind of forcing them to ignore the wildfires that are right in front of their face.
Yes, that's exactly right. And so one of the issues with that is, so fortunately, this prohibition of using forward-looking catastrophe models was eliminated in December 2024 because the situation had gotten so bad. But it doesn't change the fact that we still have this general prior approval system, that rates are still suppressed, that there's still incredible regulatory lag times. So the insurance commissioner has created something called his sustainable plan for fixing California's future, something along those lines. But the real sustainable future is just to get rid of the price controls entirely.
Mm-hmm. Okay, and then just again, I'm looking through some of this your report here. So to be clear, that FAIR program, the insurers that stay in the state are sort of getting hit from both ends. That on the one hand, if they just want to have policies in the open market, they got to go through all these hoops and whatever to get regulatory approval, even if if they have legitimate cost increases and so on, they can't as easily pass that through, as it were. But then also just with the FAIR plan, you tell me, Kristian, is it a good analogy to that, like the policies on the Obamacare exchanges that they're sort of saying, hey, if you can't get a policy, from a carrier that just on your own, law requires there's this FAIR plan, but it's not that the California state government is taking in premiums and providing insurance. That's still being provided by the private sector carriers that want to do business in the state. In other words, one of the conditions the California government is saying to the insurers is if you want to do business in our state, then you have to participate in this FAIR program and offer policies accordingly.
Yeah, so they do need to participate in it, but the FAIR plan does actually collect written premiums. And interestingly enough, the FAIR plan is not subject to Prop 103. So the premiums that the FAIR plan charges are actually way higher than the normal insurance rates. So to give you some perspective, despite the fact that California is a wildfire disaster-prone state, the average homeowners insurance premium is well below the national average. It's about $1,250 per year. And I believe the national average is somewhere around $1,900. The FAIR plan only offers wildfire coverage, I think they might offer a few other lines, but it's primarily for wildfire losses. And I believe it might be $4,000 or $5,000 a year, which is really funny that the government isn't subject to these rules, but all the other insurers are. So the issue with the FAIR plan is the fact that when you look at their written premiums compared to their overall exposure, they are on the brink of almost financial insolvency. Due to the Los Angeles wildfires, there has already been a $1 billion FAIR bailout for the FAIR plan. And according to California law, as part of a condition of their ability to operate in California, licensed insurers are responsible for FAIR plan losses when they cannot pay out their claims. So, and I think last year there was a rule change that some of those expenses are allowed to be passed on to normal insurance policyholders. But the fact remains that there is no such thing as a free lunch, and we have this massive bloated liability system, and licensed insurers in the state are going to be responsible for it if it fails.
Mm-hmm. Okay, so thanks for clarifying. And yeah, and I guess my analogy still does work because under the Affordable Care Act, the policies that you could get on the exchanges were not affordable. So there you go. I just remember when I got it was, I had originally had like what would be called a catastrophic health plan. Very high deductibles. And it was just the kind of thing like, yeah, if I get into a car accident or I get cancer or something, I want to be covered. But other than that, I'll just pay out of pocket. And then, Obamacare came in and I had to get one of their plans. And then I thought, oh, well, at least my premium and the premium went way up, but I thought, oh, at least the deductibles and stuff will come down. No, my deductible was even higher than it had been on the other one.
Very similar situation.
But at the very least, the good thing was that this way, if I got pregnant, then, that was covered. So, because they weren't, I wasn't allowed to get a bare bones policy that didn't have maternity provisions. Okay. So one thing I liked in your paper that you spelled out, a cynic might say, Kristian, that, you libertarian free market types, whenever something bad happens, especially like in the marketplace, you just go searching around for some government intervention that's loosely related and say, oh, it must be that. And so here, we can all see, yeah, the issue is for some reason the insurers are pulling out of the California market. And we know, there's this Prop 103, whatever. But in terms of like saying, is that really a big deal? Like one question that had occurred to me was to say, is the regulation on rate setting in California, how does that compare to other states? Like, it's not like there's a laissez-faire utopia in the business world everywhere else. And so I'm just going to read a little paragraph here that, Kristian, you can elaborate if you want. Let me read two paragraphs. Price controls have handicapped insurance providers and constrained their ability to be properly compensated for the risks they are incurring. Regulatory rate suppression is the difference between actuarially sound insurance rates and the rates that regulators approve. Research by the International Center for Law and Economics revealed that California ranks the worst in the nation in terms of regulatory rate suppression. And then you also go on to say the R Street Institute publishes a biennial report card ranking insurance regulatory environments throughout the U.S. And in their 2024 report, they rated California as the worst state in the nation for, quote, underwriting freedom. Mm-hmm. Okay. Meaning, folks, like the freedom in the underwriting process, yes, right? So not that they're underwriting freedom. That sounds cool. Like I want to start a company that we underwrite freedom. So anyway, do you want to so my point, folks, just to make sure you catch it, is I'm saying Kristian in his analysis, he's not just searching about for, there's this Prop 103 that's about insurance. And so maybe that has it, like, he's documenting that California, by these two independent ratings the different organizations put out, ranks dead last in the U.S. on this narrow topic of the freedom of insurers to set the rates that they feel are appropriate.
Yeah, so in response to that, I'll say that Proposition 103, because I understand like the argument that you're making, that you can, some libertarians might just go and look around for something that looks vaguely related to an issue and try to tie it in. But in the instance of Prop 103, this is the defining regulation for the entire California marketplace. This controls everything. And interestingly enough, when Proposition 103 was passed, the primary focus in the voter's guide and to the public was about auto rates. So Proposition 103, I think it's called part of the title is the rate rollback initiative, because one of the original things that Prop 103 promised was the fact that they rolled the then rates back by 20%. And the primary focus of that was on auto, by the way, because that was what the public was really concerned about. But to give you another example about how severe the situation in California is, so the FAIR plan, as I mentioned, is actually not subject to Prop 103, but it is subject to the same regulatory bodies that Prop 103 would subject other insurers to. So the FAIR plan in 2021 had a rate need of 70%. This means that based on their total liability, based on their risk metrics, they thought that they needed a 70% increase in rates in order to justify the amount of exposure that they had. Instead, they didn't think they were going to get that. They instead applied for a 48.8% rate increase, but ultimately, the Department of Insurance only approved them for a 15.7% increase. So 15 out of 70. And if that's for the FAIR plan, the insurer of last resort, can you imagine what sort of price controls are being put onto the average normal insurer?
Right. Okay. And then, to go along with what you're saying here, so in terms of, and thank you for correcting me before, in terms of like, the who gets the premiums for the FAIR plan, how that works. But you say here, if the FAIR plan cannot pay its claims, licensed insurance companies operating in California are liable. In December 2023, the commissioner stated that, quote, if the FAIR plan experiences a massive loss and cannot pay its claims, by law, insurance companies are on the hook for the unpaid FAIR plan losses. And the commissioner reiterated in July of 2024 that in an extreme worst case scenario, the FAIR plan's losses would be recouped by surcharges on residential and commercial insurance policies statewide. Okay, so that's the specific mechanism that, again, we're just trying to understand why would these insurers be pulling out of the market. And it's because, again, they're kind of getting hit from both ends, that they're not allowed to charge what makes sense to them looking forward, which is, all that would matter, because these losses would occur in the future. And if the FAIR plan is underwater and they can't pay what they owe, then if you're operating in the state of California, you're on the hook for that.
So as I mentioned previously, it's a little bit difficult to discuss the topic of insurance because you read the report. There's so many different facets of it. It's almost like difficult to choose where do you begin when you're trying to analyze this issue. So on one hand, you have the rate suppression, and that affects insurers. But on top of that, you have this additional liability from the FAIR plan. So when you're just looking at the general business environment of California, it's just another contributing factor for why would businesses want to operate here when this is the situation?
Right. Folks, let's take a break from the action to talk about today's sponsor, which is Monetary Metals. Now, let me say something before you tune this out. In case you were unaware, if you want to participate with the program at Monetary Metals, you don't need to ship them pre-existing gold and silver that you may already have owned. No, you can just wire them money and they can go buy the metal on your behalf and then go ahead and enroll it in the program. So I just wanted to clarify to make sure people who don't already own physical gold and silver realize you also can participate in this. So gold prices right now are at an all-time high, but price appreciation isn't the only way to profit. You can earn a yield on gold paid in gold without selling your metal. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means you're earning more ounces in your account every month, not in paper. Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program, and you start earning that 4% yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold or silver during the year. Now, you can step outside the dollar system entirely and compound your wealth in a monetary asset that's not a central bank liability. The question's this: why earn in dollars when you can earn in gold? Join thousands of investors, including myself, earning interest in physical gold and silver every month with Monetary Metals. For more details, go to monetary-metals.com/Murphy. Once again, go to monetary-metals.com/Murphy to see more details. Okay, let's get back to the show. Okay, so just looking ahead here at your policy recommendations, so you've got three main ones here. So you've already talked about, eliminating the restrictions on the rate setting, and you actually just call for the outright repeal of Prop 103. Now, I don't know, how does that work? This is kind of goofy, but for people who don't live in California, you guys have a lot of props that you do. Can you just explain, what does that mean? Because I think in some states, they don't have that. They don't even know what you're talking about.
Yeah, so it actually is a little bit difficult to understand because the language of Prop 103, the way that was written, says that it cannot be amended except to further the purposes of the proposition. So like the original spirit of the proposition, the bill. So every time that there's been that people have tried to reform Prop 103, you can just have someone in Congress or like a judge say, oh, well, that doesn't further the purposes, therefore reforms are shot down. In order to repeal Prop 103 and to get rid of this prior approval process, you actually need to go to the voters and hold a voter initiative to repeal Prop 103.
Okay. All right. And so is the idea that that's harder to do than just finding some representative to introduce it in a committee or something?
Yes, absolutely.
Okay.
I think it takes a lot more money, and at the end of the day, it takes convincing the public that this is a big deal.
Right, because the prop stands for proposition. Like this ends up on the ballot and people vote on it. Okay. Off the top of your head, like, do you have any sense of, like you're saying, in the perfect world, we would just get rid of this thing altogether? Is that, do Californians really like it? Like, in other words, are they like, oh yeah, these greedy insurance companies went right when you need it, they pull out of the state. I'm glad we got Prop 103 there to keep them honest. Is like that how they think about it? Or do they recognize Prop 103 is driving the insurers out?
So in my opinion, after talking to a lot of people about this issue, there's like this old adage that people really don't care about an issue until it comes to their neighborhood. Well, for Prop 103, it has finally come to their neighborhood, the people of California. When it comes to these rich communities like Pacific Palisades, like La Cañada, like Malibu, lots of these places in LA that, have a lot of wealthy people that are used to a certain way and used to voting a certain way, all of a sudden those people now do not have home insurance coverage. So it's caused them to think rationally about what an insurance market should be. So when I've discussed other libertarian issues with people, there's a lot of partisanship. You can imagine that people in California are not very receptive to certain ideas that the free market community believes in. But after speaking with many Democrats and many liberals about this topic specifically, I really get the impression that there's bipartisan support. And if someone were to launch this initiative, I think it could go far.
Okay, great. Can you just expand? And again, I don't mean to spring this on you in case you're not sure, but because as I'm just sitting here, what you just said, that people are having difficulty getting homeowners insurance. And so it's occurring, like when you buy a house, to get a mortgage on it, you got to have insurance. The bank doesn't want to lend you a bunch of money on some home, and if it burns down, then the bank doesn't get, the loan paid back. So I'm just saying, like, that would, if it really becomes difficult to get newly issued homeowners insurance policies, that's going to anger a lot of people and screw up a lot of stuff. So I would think, like you're saying, eventually there would be a coalition of wealthy interests behind this to realize this is crazy.
Oh, absolutely. If people cannot get insurance, as you mentioned, it's necessary for a mortgage. Insurance it's not something that the average person thinks about a lot, but it truly, in terms of our financial system, it is the backbone of an economy. And if you have a whole generation of people who's not able to, we do have a housing crisis, but assuming that they're able to buy a house, assuming that they're not able to secure a mortgage just because of the lack of insurance, that is a huge deal.
Yeah. Yep. Okay, because again, it would just be one other reason that, like, oh yeah, if you want to pay cash, you can, but you can't. You're not going to be able to get a mortgage. Okay, and so that was one main thing is you're saying, hey, we got to reform the rate setting and repeal Prop 103. Then you also have a section on wildfire policy reforms. Do you want to touch on some of those?
Yes, no problem. So when you're thinking about insurance, I tried to describe this earlier, but I'll do it again. When you think about the insurance market, there's two things you need to consider. You need to consider the written premiums, and you need to consider the risk that match that underlying premium. So in order to solve the California situation, there's two ways to go about it. Preferably, you should do both. You can either tackle the premium end or you can tackle the risk end. So to discuss risk mitigation for a second, one of the biggest issues is that California has an extreme wildfire problem. So if you look over the data for the last few decades, which I have in front of me, one moment, you can see that 9 out of the top biggest fires in California history, even excluding the Los Angeles fires, so this is before LA fires, in terms of acres burned, have occurred since 2017. If you know about the Camp Fire, the fires in 2017, 2018, it just burned hundreds of thousands, if not millions of acres. And the average annual loss due to wildfires from 1999 to 2008 was $400 million in 2018 dollars. But from 2009 to 2018, the average figure was almost $1 billion per year. So not only are more acres burning, but these wildfires are becoming increasingly devastating. So in order to tackle wildfire risk, the state needs to do a few key things. One of the biggest issues that the state has done is prioritizing wildfire suppression over wildfire prevention. And as you can imagine, once a wildfire has started, it's sort of difficult to suppress it. I mean, you saw with the LA wildfires, they couldn't even put helicopters into the air because the winds were so ferocious. If you had prevented that situation, it would have been far more effective. So there's certain things that the state should do. In Northern California especially, controlled burns are a really effective way of mitigating wildfire risk. Down south in LA, well, throughout all the state, but especially down south, minimizing the risk of transmission lines by doing public safety power shutoffs. When you eliminate power before a red flag warning, before a windstorm. Right now it's speculated that the Eaton fire in Altadena was caused by failed transmission lines, just like the Lahaina fire in Maui, Hawaii. To do something like that, to cut the wire, or even better, to move the lines underground or to insulate them, totally minimizes the risk of transmission lines. And then if you have no means to start a fire, it really shouldn't matter how strong the wind is.
Right. And I know, just going along with what you're saying, that when I had Lawrence McQuillan on, some of this is coming from the mentality of historically that, man is encroaching on nature and the optimal thing to do is just to let it go. And so, given that a hands-off approach and that is conducive to, you're saying, once a fire starts, it's going to get out of control. Whereas, some of the recommendations you're giving in your report and you just touched on here involve controlled burns and things, to thin it out, to get some of the underbrush. So to treat it more like a manicured garden as opposed to just a wild, forest. I'm exaggerating, but so anyway, you've got some quotes in there from the various conservation officials and whatnot that are underscoring they're at least realizing that, we need to change our approach here. We have to be more hands-on and go in and try to, interfere, as it were, to not make the conditions so ripe so that when a spark hits, boom, you've got a massive out of control wildfire.
Yeah, going back to what Lawrence has said, he's one of my colleagues at the Independent Institute. I think one of the things that he's often said is that if the government's going to control this land, they need to be good stewards of the land. And I believe the Native Americans and other groups have been doing controlled burns for generations. So in biomes where it's an applicable mitigation strategy, we absolutely need to be preventing the buildup of dead wood and brush and things like that.
Yep. Okay. And then the last section you have here in terms of, what reforms could we do? You've got housing reforms. So do you want to just speak to, some of the points you touched on there?
Yeah, so as I mentioned, California is subject to immense wildfire risk, but that their risk is not equally distributed throughout the state. There are some areas that are more risky than others. In particular, the wildland urban interface is the areas in which nature and wildlands collide with civilization. So to imagine this, you can imagine foothills, areas right at the edge of a forest, areas that are completely within the forest. You can imagine that the wildfire risk in those areas is way greater than an urban core. One of the biggest issues with the U.S. generally, but especially California in this scenario, is the fact that we have really restrictive housing and zoning laws. So because single-family zoning was so common in California, when you fly above LA, you will see urban sprawl that is unbelievable. I mean, you can't even see the end of it. Houses were just built further and further out, and because developers had no option to build up, they instead built out. And eventually, that out led to the collision of the WUI, the Wildland Urban Interface, with civilization, and places like Malibu, Altadena, Pacific Palisades, the places that burned during the Los Angeles wildfires, they are all part of this WUI zone. So if we were to reform our housing laws to enable greater housing density through the abolition of single-family zoning, California has an immense housing crisis. There is so much demand for affordable housing in the state that if we allow the market supply to cater to that demand, there will be density. If we reform our laws to allow for the formation of this affordable, dense urban housing, people will have the option to live in urban cores far away from the WI, where it's much, much safer for their personal lives and property.
Okay, great. Let me just restate that. You said it perfectly fine, Kristian. I want to make sure that, because it's a critical point you hit there. Some outside cynic, especially one who's not a fan of the market economy, would say, "Are you kidding me? Right? Like, man's already doing too much. Where these Mother Nature's telling us to mind our own business, and your solution, Mister capitalist policy wonk, is to get the government out of the way so the builders can build more housing. Like, duh, that's crazy." But your point is, well, it's the risk from fire on a given property is not identical across every square acre in the state. And so if developers are allowed to build like mid-rise or high-rise apartment complexes, more inland away from the brush, then people don't need to keep moving out. And so not only would that lower rents and make housing more affordable for, lower income people, which liberals claim that they want, but that it means more people would have to stop moving out further and further. And so you wouldn't be needing to build all of these homes, on the outer periphery, right where, if there's a wildfire, your house is going up.
Exactly.
Okay. All right. Very good.
So something else I'll say about that is, with regards to housing, is in a free market system where the premium they pay actually matches the risk that you entail, people would be incentivized to live in safer areas. So as of right now, right, because the rates are suppressed for everybody, if you live in an incredibly flammable area, your insurance rate probably doesn't match that. You probably don't realize how risky your choices are in terms of their potential impact on insurance companies. But you can imagine in a free market, the only people that would be able to live in these really risky areas would be people that can purchase their homes in cash and they're just willing to accept that liability, or two, wealthy people that are willing to pay $5,000 a year, $6,000 a year. In a system where you have affordable housing and free markets, the average person, there will be market pressure to live in safer areas so all in all, it just seems like market forces would collide to create a much more risk minimizing and society that doesn't put people in areas that put their life and property in jeopardy. Right.
Or at the very least, like you say, that they would accurately be charged for that. So like, if you want to pay it, go ahead. Mm-hmm. It's sort of analogous. It reminds me, Kristian, of like federally subsidized flood insurance. And so you would have all these people with wealthy properties on the eastern coast in the path of hurricanes, and they would just keep getting slammed, every 5 years or whatever. And then, look, you have to rebuild. And after a while, you say, well, why do people keep building all of these nice resorts, like right where they're going to get hit by the hurricane? And it was partly because the federal government was subsidizing them, that if they really had to just, bear the full brunt of the insurance premiums, then a lot of them wouldn't build right there. And so Anyway, yeah. Okay, well, folks, the name of the study is Why California's Homeowners Insurance Market Collapsed and How to Fix It by Kristian Forrs. I'll link, of course, at the show notes page, folks. And Kristian, are you on Twitter, or is there anywhere else you want to point people who are interested in your work?
Yes, I can be reached at kforrs@independent.org. I do have a Twitter. I think it's just Kristian Forrs _. But I'm happy to answer any questions about insurance or other issues related to California policy. The project I'm in charge of at the Independent Institute is called the California Golden Fleece Awards, with the goal of exposing waste, fraud, and abuse in California. So if anyone in the audience has any specific ideas about how California government is sort of robbing its population of opportunities or mismanaging taxpayer resources, I'm all ears. We're always looking for new topics for the Golden Fleece Awards, so I would definitely be open to any suggestions.
Okay, great. And just folks, so you can find out, Kristian starts with a K, and Forrs, his last name is spelled F-O-R-S.
Yes.
Well, Kristian, thanks for the report, and thanks for your time here and explaining it to us.
Thank you. Thank you for having me on.
Sure thing. And thanks, everybody, for tuning in. We'll see you next time.
You've just experienced another episode of The Bob Murphy Show, the podcast promoting free markets, free minds, and grateful souls. For more information and to subscribe to this podcast, visit bobmurphyshow.com.